This is joint work with Steve Forster, my colleague at Western University, Juhani Limnama from University of Chicago, Brian Meltzer from Northwestern. The previous paper we just have seen is a classical example of what I think when I say that financial advisors are really the elephant in the room when we talk about how people make financial decisions. And let me just give you a couple of numbers. 50% of households owning mutual funds in the US buy and sell mutual funds through financial advisor. And if we get to Canada, I'm using the Canada example because we'll be using Canadian data, we find that of all the retail investment assets, 80% are intermediated. So financial advisors are actually there, and they're actually part of the process. So I think we don't have a strong prior whether or not financial advisors add value, and we can easily make a case in both directions. First of all, solving the life cycle consumption problem, extremely complicated. And we know individual investors might lack the financial literacy, the financial knowledge, or might suffer behavioral biases. And so financial advisor can help and can add value with this regard. On the other end, though, financial advisors are paid, they receive commission that are based on the product they sell. So to the extent that the fee structure, the incentive structure, is not known to the clients, so there is it's opaque, and then it might be the case that market forces are not enough to make sure that we are equating the value added by the advisor to the cost of advisor. So the big limiting factor is that we really don't have data to study financial advisors. And let me just give you, these are pretty much all the papers that look at financial advisor empirically, but give you an idea of the wide range and the creativity that people had to recur to say something. So a paper look at field experiment. They send investor or fake investor into actual banks, or they use data on commercial banks from Europe, and some of these advice was actually unsolicited. So you would receive something in the mail, and then we see how you respond to that, and then that's what we drive inference on. Or they look at financial advice in the 401k, which is a very limited setting that suffer all sorts of specific biases. What's our contribution? We basically bring the data to try to weigh on this question. We use a large advisory sample of clients. So we're talking about, roughly speaking, 10,000 advisors, 800,000 clients, and all their trades and holdings for a 10 years period. What do we try to address? First of all, we try to understand how much cost to have a financial advisor. What are the benefits you get in return? We do not pretend to have to put forward a formal model, but just to give a bit of structure of what are we trying to do. Remember, the decision to hire and retain an advisor, it's something voluntary. So to the extent that you keep retaining the advisor, it has to be the case that the perceived benefits should be greater or equal to the perceived cost. In this framework, we look at three specific questions in this paper. The first one is, do advisors deliver superior investment performance to their clients? The second question is, how sensitive are clients to past performance and the fees they are charged? And the last is, do financial advisors help with the financial planning, with the saving, with solving the complicated life cycle consumption problem? And this is the fastest way I can give you a preview. No evidence of delivering superior investment performance. Some evidence of sensitivity of clients to past performance or fees. And there is evidence, indeed, that financial advisor help clients with saving decision. The outline of the talk, I lied to you. I don't use all the archival data. I also use survey data. And the reason is that we want to start setting the stage, look at a setting where people have an advisor or don't have an advisor. And turns out that there was a nice regulatory change in Canada, which allow us to really say something in terms of the causal mechanism through which advisor can affect their clients. And then to say something in terms of welfare implication, we go to the transaction data, this large advisory sample, and the question I just talked about, the value of investment advice, sensitivity, looking also at the cross-sectional variation in financial literacy of clients, and the effect on saving and decision. And here we're going to look at clients that switch advisor to say something in terms of that can more clearly identify. Yeah.
Are those advisors
they are related to mutual fund dealers. I'll explain this in a moment. So they all are dealers of mutual funds. They can only sell mutual funds, but they only have a brand of a company. I'll get to that in 5 minutes, probably, no less. OK, how do advisors affect clients? We use the Canadian Financial Monitor survey. The easiest analogous of this is the Survey of Consumer Finances. And it's important to specify that this is a repeated cross-section. So they target 1,000 customers every month. And they have a pretty comprehensive information in terms of all your holdings, all your savings accounts or credit cards. And people actually end up filling in this booklet. And when we got the file, there are 4,500 columns. They actually record if you have pets and what kind of pets you have. But they have limited information on trading activity. Basically, did you trade in the last 6 months, yes or no? Very important to answer our question, we also know if you have a financial advisor. There are specific questions that help us disentangle people that have financial advisor versus people without financial advisor. So right into the data, how are these populations different? So advised clients tend to be older, 4 years older. They tend to have higher income, 50% higher, 55 against 75. They tend to have higher net worth, 2.5 times, $212,000 versus $472, roughly 3 times as much financial assets. In terms of asset allocation, then they own more direct equity, more equity mutual funds, and less fixed income. Education, they tend to have there is a higher fraction of advised clients that have college or graduate degrees, more likely to be a owner, more likely to be retired. So you can see these two populations seems to be fundamentally different. And I think although the lunch might be having the best of us, all of you have come up by now with your story of why the decision to have an advisor is endogenous, and so we have to be very careful in drawing any conclusion. What helped us is the fact that there was this regulatory change in Canada in the early year 2000. So in February 2001, and the bylaws were posted 6 months before, so this was made public 6 months before, there was a change in the regulation. This MFADA association was introduced, and all the mutual fund dealers, the financial institutions, were required to register. So this posed compliance cost, capital requirements. So we claim that this kind of restricted the access to advisor, and I'm going to show you this in a moment. We have some rough number here. The number of dealer financial firms went down from 260 to 115. The number of advisors fell during this time frame by roughly 100,000 to 80,000. What's very good in our setting is that the change did not happen in Quebec. The change happened everywhere in Canada. In Quebec, it happened in 2004, 3.5 years later. So that kind of makes the perfect setting for a diff in diff, and that's what we do. So here, the register is everywhere but Quebec in Canada. The post is after June 2000, when the bylaws were posted, and then the variable of interest is in the interaction here. Then to estimate properly the effect of the treatment on the treated, we use this in a 2-stage least square. So let me show you the first stage. So what we have here, let's start with column 1. After the regulatory change, the probability of having an advisor goes down by 4 percentage points. This is economically significant. The unconditional mean of using an advisor is 38%, so it's roughly speaking a 10% variation in the probability of hooking up with an advisor. And this coefficient stays the same if we include household controls or province and months fixed effect. I don't have time to comment on all the numbers, but it's interesting to notice how everywhere else versus Quebec seems to be more likely to have an advisor to begin with, but after you control for household level, then this coefficient pretty much gets to 0. It's kind of a test of the fact that the treatment and the control group, at least after we control for observable, then they seem to have the same probability of hooking up with an advisor ex ante. So the second stage, what we do here, we show the coefficient on the OLS, the bias estimates, and then the coefficient on the instrumental variables. And let me start from where we find significance. We find that having a financial advisor increase the probability of owning any risky assets by 67 percentage points. You are way more likely to participate in the stock market. Conditional on participating, then you have 39%, roughly speaking, more of your portfolio invested in equity. Here we also look at the amount of automatic deposits, so money that get taken from your checking account and put into a saving account that automatically get invested. You see the coefficient here is positive, but it's not significant. The standard error gets very big. And the same for the use of these RRSP, which would be the equivalent of the IRA in the US, retirement vehicles. Again, we don't make much out of it because we don't know whether it might be that the time horizon, 3 years, is not enough to find an effect here, or it might be the effect is not there. Certainly, I'd like to point out another couple of coefficients. The log of financial assets, positive but not significant. We didn't have a strong prior getting in that in 3 years an advisor can make you wealthier. And then we have our placebo test here, which is the income. There is a positive coefficient in the OLS estimation. It was very tough for me to try to come up with a causal story why an advisor make you earn more income. And indeed, once we control for our instrument, the effect is pretty much zero. What about trading? We find an effect that if you have a financial advisor, you are more likely to own more funds, 3.4. You are more likely to have sold your assets, 34% more likely to have sold your assets in the past 6 months, and a higher number of sales. We don't find anything on the buy side, but the point estimates are very similar. This is kind of a good exercise because at least tells us something in terms of what advisors actually do with their clients. So if you have an advisor, you are more likely to participate in the stock market. You are more likely to own equity, to hold more funds, and to trade more frequently, at least on the selling side. So, but you know that these things it's difficult to drive any welfare implication unless we know your entire portfolio, we know all the transactions you made, the gain on your transaction, how much are you paying for the advisor, and possibly your risk propensities. Having more equity, generally speaking, is good, but not always, not for everyone, and not always in our life cycle. So that's where we bring in the administrative data, and let's go straight into it. As I was telling you before, it's roughly speaking 10,000 advisors. So think of it as 3 financial institutions, and 10,000 advisors. They cover 10% of the segment of mutual fund dealers in Canada. We have holdings, transaction, and all the fees paid from 2001 to 2010. For 2 out of the 3 companies, we're able to actually go back to 1999 and go forward to 2013. Some institutional setting. Ronnie, you were asking about this before. Those are mutual fund dealers, can only sell mutual funds. They sell it through captive financial advisors, so they are branded financial advisors. Each advisor is linked only to one company. It's a self-regulated industry, which is a funny way of saying that the government imposed this regulation over this company. That's what I discovered as I was looking at everything in the regulation. The clients have to fill in this Know Your Client, basically risk-taking questionnaire. There is no fiduciary standard. It's not imposed, so they have to act in their client reasonable interest, but there is no formal fiduciary duty, and the advisor cannot trade at his own discretion. So every trade has to be approved by the client. Who are those clients? So average age is roughly speaking 50 years. Half of these are women. The tenure with the current advisor is roughly speaking 3 years, but you can see there is a lot of heterogeneity. A quarter of clients in our sample have been 1 year or less, a quarter more than 5 years. Those are the number of accounts. Think of these as investment accounts or retirement accounts, on average 2. I think it's also interesting to look at the number of funds. These are only mutual funds. And average is 8, but the distribution is skewed with at least the top 10% having as many as 19 funds or more. The account value, again, is skewed. On average is $58,000. Those are only the expense ratio. I'll be elaborating a bit on this, but the expense ratio you pay on the funds you own And they go from 180 basis point to 280 basis point. And it gets worse if you go at the 99 percentile. This translates in terms of dollars. The lowest decile pays, roughly speaking, $50 per year. The highest decile, $4,000 or more. Half of the sample has a low or very low or non-financial knowledge. Half of the sample has $60,000 or less as income. The wealth, again, for half of the investor is $2,000, $200,000 or less. This is what I was referring to this before. If we pull all the assets under management at the end of 2010, then we got 41 billion that are managed by those advisors, which is 11% of this specific segment. Account type. So the largest share is in these registered retirement saving plans, which are the equivalent of the IRAs. Then we have these open accounts. You can think of these as investment accounts. The accumulation vehicle, you use this when you stop working to get some income. And these are like you saving to send your kids to college. This map nicely into the investment horizon of the investor, with 85% of our investors having an horizon of 5 years or more, 6 years or more. The advisor, average age 50, tenure again, some of them have 8 years or more at the top of the distribution, but a large fraction of them has like 1 year or less. It's interesting to note the number of clients, 74 roughly speaking on average, but the top decile has 200 clients or more. That's the expense ratio computed at the advisor level. So as I was saying before, we start with 10,000 advisors, and then when we do our alpha regression later on, we impose 12 months to be in the sample for at least 12 months to compute return. This brings us down to 7,400. And these are already kind of some descriptives about the sample. Just to give an idea, in the MFDA channel, we have 80,000 advisors. Over Canada, the number of advisors licensed to sell mutual fund is 110. Want to point this out. These advisors sell mutual funds only through this company, but they can sell some additional mixed funds and insurance products, and they have to be licensed, and we observe the number of licenses they have. So half of them have at least one additional license. Okay, now that we've described the data. No, am I? Isn't it 25? 23 or something. I started at, okay. Sorry, okay, it's okay. Okay, so do advisor, so it was 5?
He's just adjusting to the Middle East, that's all.
Oh, okay. Okay, so do advisor add value improving performance? We do alpha calculation, so let me show you the results. If we look at the average here, we compare the portfolio of the advisor, where we take all the clients, and we evaluated all their holdings, and we compute monthly returns at the advisor level. And so what do we find here is that as we go compare this to passive benchmarks, so 1 factor to 4 factor augmented with the bond factors, then the gross alpha, this is before any fees, goes down from 60 basis points to minus 30 basis points. And I think it's important here to notice, if we look at the distribution of the T of alphas, that as we look at the 4 factors here, or the 4 factor augmented, then if anything, we find that there is the distribution seems to be skewed towards the left-hand side of the tail. And this is like the reference T-stats of the distribution. So the distribution are, there is no evidence of, at least of skill from looking at this way. We're going to do this more formally in the paper. What happens if we do this net of MERs? You can imagine this. The number goes from minus 250 to minus 300 basis points. And we say that these are likely to overstate the investor realized performance, because here we are only considering the MERs, but we are not considering the front-end fees you pay directly to the advisor, or the back-end fee if you say the back-end fees if you sell before the amortization period. So you might think that, okay, this is you might think this is not a fair benchmark, so we also benchmark them against an investable benchmark, which is a lifecycle funds. We use the most commonly sold lifecycle funds in Canada, Fidelity ClearPath. And again, the story is the same. On average, net of fees, they lag the benchmark by 200 basis points. And as you could see here very clearly, most of the difference, again, is driven by fees. So we do some robustness check. So how sensitive are clients to investment performance and past fees? So what do we do here? It's pretty much we look at, is this like a Cox proportional hazard model? And we look at the duration of the accounts. And then we look at the effect of past returns on the duration of the accounts. And it's interesting to notice how the better the return, the longer the duration of the accounts. But this is entirely driven. We don't have here months fixed effect. Once we include here months fixed effect, the effect is not significant anymore. This is basically driven by economic condition more than what's happening to your portfolio. And then to analyze the convexity in the relationship, we kind of look at separately at different bins of returns. And if you look at the return distribution, the only action seems to be happening between 0 and minus 20%. And here we don't have lots of significance in the positive domain. How sensitive are clients? How sensitive are clients to past fees? Again, the higher the fees, the higher the fees you are charged, the more likely you are to quit, the lower the duration of the account. But then we will see that this is entirely driven by the high or moderate financial knowledge, and the low financial knowledge is not significant. And then you might wonder, so if high financial knowledge clients are more sensitive to fees, do they actually get charged less? And what do we find? That they do get charged less. The effect is statistically significant because we have a huge sample, but then it's not economically meaningful. 2.3 basis points out of 240. And so this kind of hints to us the idea that it's not really financial literacy explain the cross-sectional variation in fees. The last point, this take me a minute. The last point is that, okay, do advisor help clients in solving the life cycle consumption problem? And the issue here, again, is that there may be endogenous matching. So how do we try to get around it? Book of clients are extremely valuable. So if an advisor retire or dies or quit, they sell their book to someone else. And so the experiment we do here, we look how close you were. So if advisor A has 20 clients, he retired, then he sells his book to advisor B. We look how close were clients of advisor A to clients of advisor B before the switch and after the switch. What do we find? And here is the absolute difference pre and post. And a negative number here means that you look more likely your future co-clients. We find that there is a statistically economically meaningful effect on the use of these automatic saving plans, and some effect on automatic saving plans, the fees you are charged on automatic saving plans, and asset allocation, but those ones are very small. So the last one, we do this and we look at adding a plan or removing a plan. And again, we do find that all the action is on adding a plan. So if you go from advisor A to advisor B, where more people use these automatic saving plans, you are more likely to use these automatic saving plans. So to conclude, how much cost to have financial advisor? 250 to 300 basis points. And this is underestimating the actual cost because we don't have the front end and the back end fees. Rough calculations are telling us that the front end fees weights by as much as 70 basis points. Limited evidence of clients responding to investment performance and fees, but we do find some evidence that advisor help clients with savings and help clients with the asset allocation. Thank you.